Today, I'm Jason. I work in the technology consulting wing here at Top Key with all of our customer base. And really, for today's session, we're going to be talking about some of the most stressful parts of the year for you as a PM, right? 1099s. So specifically, we're going to be covering what it's going to look like to build a repeatable, clean, and defensible 1099 process, just so this tax season doesn't really turn into a fire drill. Homeowners are going to feel confident that their reporting is accurate. There's going to be three main bullets we're going to cover. What that's going to look like is how to prep your data before filing season hits, how to avoid common 1099 mistakes, and then how to confidently file for the first time. To walk us through this, we're joined by Ben Coons. He's the CEO of Keystone Bookkeepers. Ben and his team support over 150 short-term rental management companies, and they spend a lot of time in the trenches helping operators clean up their 1099 workflows. Today, Ben's going to break down how to validate your W-9s, how to determine exactly who does and does not need one, how to use your PMS as the source of truth, and how to organize and file those accurately, again, on that first pass through. So with that, Ben, I'll hand it over to you.
All right. Thanks for the intro, Jason. And thanks everyone for joining me. I'll go ahead. Got a little presentation we worked on. Can we see that now?
Yep, looks
Hopefully,
good.
yes. Okay, cool. All right. So, as Jason mentioned, I'm Ben Coons, CEO of Keystone Bookkeepers. So, we specialize in helping short-term rental operators keep their financials clean and ready for growth. And this time of year, we are focused on closing the books for year end and starting to prepare those 1099s. So, we're going to go through this process here and walk through. Jason will be monitoring the chat, but again, we'll save some space at the end for Q&A. So here's our roadmap for today. We're going to go through some practical ways to clean up your books for year end, some things to look for, especially in QuickBooks, because those issues are better addressed kind of before you hit year end than in the midst of January. As well as go through what is a W-9. We're going to go through a little 1099 decision tree, how to decide what to file, who gets those 1099s, what to put on there. A brief walkthrough on some of the different software programs that I know a lot of people might be using, whether that's Guesty Accounting or VR Platform. Then we'll walk through some practical ways to file the 1099s, and I'll give some software recommendations there as well. And then we'll end with some Q&A. All right, so what do clean books actually mean? So we say your books are ready for year end. We don't just mean that they balance. Clean books could mean that you hand them to your CPA today and use them also to make decisions. So ready for taxes, but also ready for decisions. Be able to find which properties are your best performers, what your margins are, cleaning revenue versus cleaning expense, things like that. But also, kind of getting into the nitty gritty, this means all your transactions are actually categorized. So if you're in your bank feed, that means everything, at least through the end of the year, should be recorded, whether it's a bank account, whether it's a credit card. Next big thing is reconciliation. So down here, we've got a screenshot from QuickBooks that shows the reconciliation screen. Every account should be reconciled at least monthly, definitely at year end. This is going to pick up transactions that are missing. QuickBooks is notorious for some of these issues. A bank feed could get disconnected or a credit card could get disconnected. A sub account like a new Amex or a new Chase card could get added for a new employee. And if that's not picked up, not linked into QuickBooks, those expenses might get missed. The bank and credit card reconciliation is really the best way to find those issues and make sure all your income and expenses are recorded. Couple things we also like to check, especially at year end, for those owner draws, owner investments, some of those equity accounts that people might just put some transactions in if they're not clear on those or not sure how to categorize those. We want to make sure that those really are non-business transactions. Things in there might be expenses that you made for personal transactions and you happen to use the wrong credit card. Could be funds you withdrew from the business if you've got an LLC. An owner investment might be capital that you put into the business, either for operations or for growth. But those equity accounts are ones that you want to review to make sure those are ready, those are clean. The other thing we've got in here is actually, I'm going to go to the next slide here. We're going to talk about this. Okay. Areas to focus when closing your year end. So we talked a little bit about, bank reconciliations and things like that. That should be done monthly. Year end is a little bit different. We'll spend a little bit more time kind of going through the balance sheet. Again, looking at those owner draw transactions, looking at those owner investment transactions, making sure that they're really not supposed to be on the P&L. If you've got loans, if you've got bank loans, HELOCs, line of credits, SBA loans, things like that, oftentimes those don't get reconciled on a monthly basis, but at year end, really want to tie those out. So looking at a year end statement, looking at a 1098 interest form from your bank, and making sure the interest on your P&L is going to match up with your balance sheet, with the 1098. Other areas to review, accounts receivable. So here you can run a report within QuickBooks, looking at your accounts receivable. You want to make sure that everything on there is actually collectible. If it's not collectible, we can write that off to bad debt or just delete the AR if it's recent. But what you don't want is income to be shown on your P&L as your income statement and be taxable if you're not actually going to collect that. So this is a really good time in January to review your accounts receivable report and make sure that if there is anything open, it's something that you do expect to collect on. Same thing with accounts payable. So these are bills that get entered in QuickBooks and show up in the accounts payable report. Again, we want to review these at year end to make sure that they are truly owed. So you are going to pay those vendors, maybe their owner payouts. We want to make sure that those are accurate. If not, we want to delete those as well because they're really, if you're not going to pay them, they're really not expenses that should be on your books. Other area to focus on, vacation rental taxes. So the year-end amount should equal the amount that you are going to pay, usually in January, for your vacation rental taxes. So this is something we do with all of our clients is confirm that year-end balance. We'll actually wait to see what they pay in January. Again, typically you're either filing monthly or quarterly. So we'll wait to see what those are paid and make sure that that amount at year-end matches up with the payments. Oftentimes the actual amount you collect from clients from guests is not going to equal the amount that you pay to the states or to the local counties. Oftentimes they have some discounts for early filing or for on-time filing, or different credits or things like that. Other times you didn't actually collect the full amount or the right amount from the guests, and so your payment ends up being slightly different. We want to correct and true those amounts up at year end to make sure that, again, the amount on the balance sheet is going to equal what you're paying for those Q4 taxes. We've seen a lot of clients where this balance kind of sits and grows without a real plan in place for it. We like to true those up to an other income or an other expense account in QuickBooks. So kind of below that operating income line. But again, making sure that it does show up on your P&L and that your balance sheet is accurate for year end. Last thing we want to be doing, this is really something that you should be doing kind of during the year, but at year end, this is when a lot of people really start to focus on this, is collecting W-9s. This is kind of getting into the heart of the presentation here, but W-9 should be collected from every vendor that you're paying either ACH or cash or check or Zelle, basically anything except credit card, as well as every homeowner that you are collecting rent for. So if you're collecting rent on behalf of a homeowner and paying that out to them, you should be collecting a W-9, ideally during the onboarding process. With vendors, the best time to collect it is before you make that first payment, and tell them that that first payment is contingent upon them actually giving you the W-9. We're going to walk through what a W-9 is, but again, these are areas that deserve extra scrutiny at year end before you kind of wrap those books up. All right, so what is a W-9? W-9 is an IRS document that contractors and vendors complete. It's going to give you things like their legal name, their business name, their address, and then the taxpayer identification. It's also going to provide their entity type. We're going to go through, the next slide is going to show a W-9, go through that, but it's really important that you get these because it's going to let you know who actually needs a 1099. This is a pretty standard form. Oftentimes, it's easiest to just download a blank W-9 and send it to, again, your homeowners, your vendors when you're onboarding them. W-9, you're going to need one from basically everyone that you send money to, unless you are paying vendors with credit cards. So if you got a cleaner that you're paying 100% with a credit card, you don't need to get a W-9 from them. But if it's going to be a mix, if there's going to be some non-credit card payments, again, Zelle falls in that category, or ACH payments, or paying through TopKey, for instance, you are going to want to get that W-9. And again, all homeowners should be the legal owner of the property on that W-9. Landlords, if you rent an office space, also arbitrage homeowners. So if you are running an arbitrage model and you are, renting that home and then turning around, renting it out on Airbnb, Vrbo, you want to get a W-9 from the landlord that owns the property. All right, so reading a W-9, most of it is pretty self-explanatory. It's going to have the name, the address, the EIN or social security number, but this middle section here is really important. So we're going to walk through kind of how to read this and what it means in terms of issuing a W-9 or a 1099. So this is letting you know what type of entity the end user is, so the vendor or the homeowner or the landlord. So if they are an individual or sole proprietor or a single member LLC, you're going to be issuing a 1099 to them. You do not have to issue 1099s to C Corps or S Corps. If they're a partnership, you do need to issue. You don't need to issue to trust or estates. And then down here, the IRS likes to make this confusing, so they added a separate section for LLC companies because LLCs can be taxed as C corporations, S corporations, or partnerships. So if they check this box and then they put a C or an S over here, you do not need to send a 1099. If they've got a P, you do need to send one. So if you get a W-9 back from a homeowner or a vendor and it does not have this section filled out, we highly recommend that you send it back to them and ask them to fully complete this, because this is going to be what you want to store with your vendor records, and that's going to be your backup for ensuring that you are issuing 1099s to the right individuals. So again, we exclude those C Corps, those S Corps. Again, typically people are not, if we're talking about homeowners, typically homeowners are not holding real estate in a C Corp or an S Corp. Typically they're going to hold them either in their personal name, they're going to hold them in a single member LLC, or they're going to hold them in a partnership if they've got more than one owner. So more than likely, your homeowners are going to either fall in this first bucket here, the individual or sole proprietor, or they're going to fall in the partnership. Pretty rare, again, to have the C Corp or the S Corp. Occasionally, you might have a trust or estate where you don't need to issue one. Vendors, on the other hand, again, typically the ones that you're paying cash or check or ACH, those are going to be, fall in your sole proprietor or individual or single member LLCs as well. All right, so here we've got a little decision tree, and hopefully this is big enough for everyone to see, but this is what we use internally for all of our staff to train on, and just kind of walks through should that vendor or homeowner get a 1099. So if we paid them for rent and it was $600 or more, and we paid them via bank account, cash, Zelle, Bill.com, TopKey, anything like that, and they're not, again, not a C Corp or S Corp, we are going to issue a 1099. That $600 threshold, I think it exists for one more year, I believe, and then they are going to slowly increase that. But for now, that $600 threshold is key to remember for homeowners and for vendors. So if you're paying someone less than the $600, you do not need to issue the 1099 for the year. That's why, kind of going back to that first slide or second slide, it's really important to track in QuickBooks and make sure that all your vendors or all your transactions have vendor names, because it's a lot easier to run a report in QuickBooks by vendor and see the payments made for the year. If you're using a system like TopKey for the full year, you can also run reports in there to find expenses by vendor. But you're going to want to check and see if you paid $600 or more to those vendors. If you're paying with a credit card, PayPal, Venmo, things like that, you do not need to issue a 1099. The third-party network is going to issue it. They're going to get a 1099K, so you don't need to issue one from your system. But again, any non-credit card transactions, if they are not a C or S Corp, we're going to be issuing a 1099. All the little nuance here is all attorney fees. If you've got legal fees, you're always going to want to issue a 1099, regardless of whether they are C Corp or S Corp. So again, IRS likes to include all sorts of fun little wrinkles to make sure that everyone jumps through the right hoops. All right, so looking at vendors, again, I just mentioned this, but every expense, again, if you're using QuickBooks or using a system like TopKey, every expense really needs to have a vendor name. That's going to make it a lot easier at year end, which is now, to run that report to figure out expenses by vendor. Homeowner is a little trickier. Oftentimes, QuickBooks is really not going to be the best source of truth for payments to homeowners in terms of getting the amounts. QuickBooks or your bank account is going to show the net payout to homeowners. So if whatever your owner statement says at the end of the month, that is what's going to reflect again in QuickBooks and in the bank account. But that is not what you need to report on the 1099. This is one of the common misconceptions that we see. Both homeowners and property managers can get confused on this. 1099 should just include gross rent. That's going to include things like accommodation fare. It's going to include cleaning income if it's passed back to the homeowner. If you keep cleaning income as a property management revenue and it's not on the owner statement, then it does not get included in the 1099. Resolutions, again, if those are passed back to the homeowner, they would be on there. Any other revenue items, these could include things like pet fees, early and late checkouts, damage waivers, pool heating, really anything like that. If it's paid out to the homeowner and it's on the statement, then it needs to go on the 1099. If it's kept as property management revenue, so if you keep the pet fees, if you keep those late checkout fees, it does not need to go on the 1099. What's missing, what's not included here, commission, channel fees, operating expenses. The homeowner is going to be responsible for itemizing and deducting those separately on their tax return. You are giving them really that top line rent number that they're going to plug in for their taxes, and that should tie out to the rent that's on your owner statements. But again, it will not tie out to the actual payouts because the payout takes into account commission and channel fees and expenses. So two numbers will not tie there. All right, so we're going to briefly touch on a couple of different platforms. So if you're using Guesty Accounting, I think it's in beta still. But if you're in the accounting section, you can go into the 1099 tax forms. You can choose that net rental income only, and it's going to pull out total owner revenue for the year. So this is a really nice way to easily pull out accommodation fare or really all revenue that was on the owner statements for the year if you've been using Guesty Accounting for the full year. I believe they also have a way where you can add in rent collected prior to going live with Guesty if you went in mid-month. VR platform, again, similar. They're going to have a tax statement section. You can actually you have to go into settings, add some which QuickBooks accounts you're pulling from. But here, again, these software platforms make it a little easier to actually pull out the gross rent, gross accommodation fare. If you're not using, again, an owner statement platform like one of these, your PMS is going to be your best friend here. So running a report, this is where you really need to know like what's going on your owner statements, but running a report for that accommodation fare, again, if you put cleaning income and pass those back to homeowners, you're going to want to include that in the report from the PMS. But really downloading that to Excel, sorting it by listing, and adding it up for the year is probably going to be your best approach. Split year platforms. So if you did switch property management systems or owner statement platforms, you want to be careful here. You want to make sure that you're pulling in really a full year of data. Oftentimes when you switch PMS, you're not bringing in all that historical reservation data. So hopefully you still have access to your old PMS, or if not, you've downloaded reports and saved some files from there. Worst case, you might have to comb through the owner statements and manually add those up for the months that you went months before you went live with the new system. And again, if you switched owner statement platforms, maybe you're using something like, maybe you're doing them manually and switch to something like VR platform midway through the year, you're going to need to add all that rent for this period before you went live with the software. So really just be cognizant if you made any kind of software changes during the year, the odds are the new software that you're using is not going to have a full year. So you're just going to need to find a way to go back and get that rent, get that gross accommodation fare from the prior period or prior months. Year-end requests. So these are some of the most frequent homeowner requests that we see that our clients get. End of the year, you send them the 1099 and they go, all right, this is great, but what do I do with this? A lot of clients find it helpful to send an annual summary. So something that's going to show your total rent. And again, that should tie to your 1099 that you're sending. And then all the different expenses for the year. So your different management commissions, your operating expenses, your channel fees, anything else that you're charging, your tech fees, anything else you're charging to homeowners, because they are going to take that and turn around and either give that to their CPA or plug it into their tax software so that they can get a taxable report for the year for their property. All of this does come from those owner statements, but most homeowners are probably not saving all those and tracking them and adding them all on their own. So something that some of the owner statement softwares like a VR platform or a clearing is going to do, they're going to have a year-end summary that the homeowner can reference. But if you're doing this on your own, if you're doing these owner statements manually, I would recommend kind of coming up with some way to compile an annual summary and kind of head off a lot of those questions. Another question that we get is why the 1099 that we issued does not match what was paid for the year. So again, we can't look at the amount that was paid out of the bank and received by the homeowner because that is net of all the expenses and the commission. The 1099 is going to reflect that gross revenue number. So that's why it's really nice to have an annual summary because you can point to the rent on there and then the net amount will tie to what was paid for the year. So it's really nice to be able to point to them and kind of show them where those numbers line up to kind of head off a lot of those questions and issues. Another question we get typically is why does the 1099 include funds that were paid in January? That's because they were collected during the month of December. The way we run all of our clients is we run them on an accrual basis. What that means is we are going to report the 1099 based on the owner statements and based on that rent collection and paid out to homeowners. So if you, for instance, are recognizing booking revenue on your owner statements based on check-in, that 1099 is going to include every reservation that checked in for, from January through December of the prior year. It doesn't matter that some of those get paid out in January. That rent was collected, the guests stayed in the month of December, and so it's going to be included in the 1099. All right, switching gears a little bit, talking about 1099s that you, the property manager, will receive. So you're going to be sending out these 1099s to the homeowners. You're also going to receive 1099s from Airbnb, Stripe, Booking.com, or some of the other OTA channels. This is basically going to encapsulate the full amount that was paid out to you, the property manager, assuming you're doing trust accounting. This will not apply to people doing co-host. But if you are collecting those funds into your trust account, the OTAs are going to send you those 1099 forms. that reflects the total amount rent collected and paid to you. Odds are this is not going to tie to your P&L revenue if you're doing like true trust accounting and not putting guest booking revenue on your P&L. So what we recommend is making a tax-only adjustment to add, basically to increase your taxable income, but also your expenses by the amount of those 1099s so that the impact is zero. It doesn't change your taxable income. So say you got $1 million in booking revenue, you would add $1 million to revenue and $1 million to expense. It would net out to zero. But that way it ties with your with the 1099s because these also get sent to the IRS. So what you don't want is for you to report, 100,000 in revenue and these OTAs to send to the IRS that you got $1 million in revenue. And that's an easy red flag for the IRS. So again, we recommend adding it to your revenue, adding it to your expense. Your revenue is supported by these 1099s that you're receiving, and your expense is going to get supported by the 1099s that you are sending out to your homeowners. That way, everything kind of ties out nicely and avoids some of those red flags with the IRS. All right, so now it comes time to file 1099s. A few different softwares. We use Avalara, which was formerly Track 1099. I think they still kind of co-brand that. A couple other ones that we see in the accounting community are Tax 1099 and Tax Bandits. QuickBooks Online will tell you that they can do it, but I do not recommend you use QuickBooks 1099 module. Like a lot of things with QuickBooks, anything kind of outside their core feature, it works fine if everything goes properly. But what doesn't happen, what they're really bad at, is making adjustments if there are any errors or changes. We have to do, I'd say, a decent amount of corrected 1099s. Once homeowners get them, maybe the legal entity of their business is wrong, or it's the property is held by an LLC instead of their personal name, and we issue the 1099 to their personal name. Maybe an address needs to get updated or things like that. These top few softwares make it very easy to correct and reissue 1099s. It's like a 30-second process and it refiles it. QuickBooks Online cannot change and reissue a 1099. So for that reason, would not recommend using them. I'd recommend using, again, something that's purpose-built for this process. These will link into QuickBooks. So if you're storing your vendor information in QuickBooks, you can pull that directly from there. It'll pull the vendor amounts for the year as well. The homeowner amounts will not match because those, again, are not correct in QuickBooks because it's going to show the net amount paid. So you will need to go in and either manually update within like a Track 1099, or if you've got an Excel spreadsheet in their format, you can upload that as well. But just remember, do not file with the amount that pulls out of QuickBooks. Again, even if you're using QuickBooks to file it, you don't want to file with the amount that they have for each homeowner in there because that will not tie to gross rent. But something like Track 1099, it's going to show you, here's a little snippet. It's going to file with the IRS. It's going to file with the state. It's going to send an email if you've got their email to the vendor, to the homeowner, and let them go in and log in and download their 1099 electronically. If you don't have an email, they'll also take care of mailing those to the vendors or to the homeowners. They'll tell you if there's any errors. Typically, what happens is a homeowner or vendor types in the wrong EIN or social security number that we have on file, and we just need to let them know which one we filed with so they can get in. It'll show you which ones were mailed. You can also do things like a TIN check, taxpayer identification check, to make sure that what you're filing actually matches the IRS database. So it's got a few things in here that can kind of reduce some of those headaches, reduce some of those errors, and allow you to be a little bit more proactive with your homeowners and making sure that they're actually receiving these 1099s. Otherwise, they might come back to you a few months later, like, hey, I never got this. Here you've got a paper trail to show you, no, we did file this, we did email this out to you, or we did mail it. You can also pull PDF reports directly from here and send those out to homeowners if they have trouble accessing it. All right, so stepping back, looking ahead once you get through January, some monthly habits that are good to practice to get into so that you don't run into a crunch at the end of the year. Make sure you're reconciling those bank accounts and credit cards on a monthly basis. Make sure you're reconciling your loans. Make sure you're adding and checking vendor names as you go. Make sure those are recorded correctly. Again, if you're using a bill pay software like TopKey, or if you're using QuickBooks, make sure those are consistent and the same. And then collect those W-9s. Can't stress this one enough. I don't even know how many W-9s we are trying to chase right now with our clients, but we'll probably file 2 to 3,000 1099s this year. And we have, a lot of W-9s still to chase, even though we do like kind of a quarterly check for them. Uh, it is hard to get, everyone's busy this time of year. People are coming back from the holidays. People have other things going on in their lives. It is a lot easier to get those W-9s, again, when you're onboarding a homeowner before you pay a vendor, rather than trying to chase someone in January to figure this out. All right. So that's everything I prepared. But again, happy to answer questions if anything has come up in the chat.
Yeah, there's a couple here. Ben, go ahead and read some of these off for us. First one we have here is there any harm in doing a 1099 for someone who doesn't need one? Trust, for instance.
That's a good question, and typically no. There's really no harm in it, because again, assuming they are reporting their revenue correctly, then you should have no issues. Um, and some people actually might request one, even if they've got a trust or an S corp, they might ask for one. And so no, there's no harm in filing one, even for someone that doesn't technically need it.
Okay. Next one, should we send based on when payments were made? For instance, December 25th payments that are actually paid in January 26th.
Yeah,
Or,
so we tend to follow an accrual method. So if you've got a December owner statement, even though that's paid out in January, we include that with the, December with that 2025 1099, because that is going to be what rent was collected, guest stayed in the year, you, the property manager, collected the rent. That is also going to be on the 1099 that Airbnb, for instance, sends you for the year. So in order to have that kind of match up timing wise, we do recommend, again, keeping that on an accrual basis and including that in the year.
we have another question. Can you go over what you recommend if you've paid rent or for services but cannot collect a W-9?
Yes, that's a good one too. So with some of these online platforms, you actually can still file a 1099 for someone if you've got kind of basic information, name and address. You actually you can file without an EIN, without kind of making an entity selection, as long as you've got a few basic points there. So we definitely come across that. Some people are just hesitant to give it, or we just can't chase them down. But as long as we have a name and address, you can actually still file that. And so again, we recommend just filing even if you don't know the entity type, just to make sure you're covered.
Okay, I've got a few more here. Next is, can you expand on why you do top line revenue instead of what was actually paid out?
Yeah, that's because that is really what the 1099 is for. I didn't touch on this. There's two types of 1099s. There's a 1099-NEC, which stands for non-employee compensation. That's what you are going to send to your vendors. And then there's a 1099-MISC, miscellaneous, which is and you're going to put rent in box one. So they specifically in the form call out that this is rent. It is not meant to be a net amount. It really is the rent amount that you collect on behalf of them. So really we're following like the IRS guidelines here and making sure we're putting the right amounts in the right boxes of the 1099.
Is it okay to report on the 1099 the net amount paid to an owner as reflected on the bottom line of their owner statement?
Yeah, so that goes back to the one I just answered. We don't recommend it. Is it possible? Sure. If it is, you really just want to communicate that to your homeowner and make sure they're aware of what you're filing. But again, we strongly recommend that you follow the IRS guidelines here and file with the gross rent amount as opposed to the net payout amount.
Okay, one more here. We are a cash basis company and send owner 1099s based on the period when the cash was paid. The reporting prepared for owners on rent received and expenses is very manual due to this.
That sounds manual. Yes. As long as you're matching everything, which it sounds like you are, like that sounds fine. If you're going to track cash received, that can be tough because, if you're getting bookings on Verbo or direct bookings and you're getting 50% payments up front, that might kind of cross calendar years. So that's going to increase your kind of compliance and tracking costs there and time you spend, as opposed to if you do it again on the accrual basis where you really can point to the owner statements that you do for the month, um, and file based on those. So again, it sounds like it's being done correctly, and you certainly can do these on a cash basis. It just typically means you're spending a lot more time tracking, when things actually hit the bank.
What if you can't complete all W-9s for vendors? For example, we had a cleaner that we can no longer contact who left us hanging during a turnover.
Yeah. So again, if you've got their name and address, and you can't get their W-9, you can still file based on that. So, we try as much as we can to get some kind of information. I won't say that that everyone's able to file 100% of the time with your vendors, but we just recommend doing as best you can. And again, making sure you collect a W-9 before you make any kind of payment.
Someone here in the chat as well. Do you only add attorney fees or all fees, including attorney for corpse?
So attorneys are kind of called out separately, and so they will get a 1099 regardless of their entity type. So even if they're a C Corp or an S Corp, they're still going to get a 1099. But if you've got, for instance, your CPA, if the CPA is an S Corp or a C Corp, you don't owe them a 1099. So it really just calls out those attorneys specifically.